Good afternoon. Thank you for joining us. My name is Marcus, and I'm a market analyst for Modo Energy.
Hi, and I'm Wendell, Director of Australia here at Modo, and I also head up our research.
So today we're going to be covering the investment case for BESS in the NEM. We're going to start by looking at our October 2025 forecast release. We're going to be looking at what new functionality we've added in, as well as what key input changes have happened since last quarter. Then we're going to be looking at state of BESS in the NEM. So looking at the BESS pipeline, how BESS's revenues have changed, and how well they're capturing this through our capture rate analysis. Then we're going to be looking at what you should think about if you're investing in BESS. So this recaps our latest research reports and all the key insights. And then we're going to be looking at our BESS investment outlook, which is our forecast section. And finally, our Q&A. So we have a team on standby who are ready to answer your questions. So feel free to leave them as you think of them.
Yeah, and also we'll have about 15 minutes at the end of the session for any questions that the team don't get around to answering or we prefer to answer live.
So who is Modo Energy? At Modo Energy, we are the global standard for benchmarking and valuing electrification assets. So we provide revenue forecasts, we provide benchmarks, as well as client-led research across the US, GB, and Australia. I'm going to hand to Wendell now to discuss our forecast release.
Awesome. Thanks, Marcus. So just as a quick introduction, for anyone not aware, so at Modo Energy, we produce long-term bankable revenue forecasts for battery energy storage, both standalone and co-located across the globe. And so as under a Modo Energy subscription, as the default, you get access to this. So this is running a forecast on the terminal. And this allows you to get asset level forecasts at a sub-state granularity built on our 5-minute long-term power price forecast. And so we've got new features which we've introduced this quarter. And so the first of which we'll touch on later, is inclusion of cap contracts in our revenue forecast as an option. We think this is really important if you're valuing the long-term value of your battery project, and we'll come back to that later. We've also introduced co-location, as I mentioned, so you can now run revenue forecasts for hybrid BESS projects, both AC coupled and DC coupled. And finally, we've introduced a change to allow both max annual cycling, so essentially hitting, say, 365 cycles a year, as well as max daily cycles. And so what this does is it gives you the tools to test different configurations of your battery or different operational strategies and the impact that ultimately has on revenues. There's some major assumption changes which we've had this quarter. So the first of which is around demand. So in the last 3 months, AEMO released their latest ESU, which is their long-term projections of demand in the NEM. And so one of the big changes that has happened this time is the inclusion of data centers in there. So this is a trend we're seeing globally, and this is also the same in the NEM, with a pretty significant increase in data center demand forecast over the next 5-6 years. So at the moment, there's around 4 terawatt-hours of electricity demand annually from data centers in the NEM, but this is anticipated to grow to 20 terawatt-hours in 2031. Long term, this is expected to continue to grow, ultimately hitting around 40 terawatt-hours in 2055, at which point this will account for around 10 to 15% of annual energy demand in the NEM. The other major change we've made is around retirement dates for some thermal assets, which are really big input assumptions going forward. So there's 2 main changes, both around coal power stations we made this quarter. The first of which is we've pushed back the retirement of 2 units at Eraring back to 2029. And so really this just reflects the ongoing uncertainty over the retirement schedule for this plant, as well as actually some statements which have come out from Origin recently. Secondly, Gladstone was the subject of a statement by Rio Tinto recently, indicating that they might look to close the plant early. We haven't actually made that much of a change yet. We're sort of in wait and see. But what we have done is we brought forward the retirement of 2 units to 2032. And actually, this reflects the economics that we see of this plant, where keeping those 6 units online through to 2035 is just not economic. Finally, we've made some changes around our assumptions on sort of household and distributed battery energy storage capacity. So really, this just reflects the really successful uptake of the government's household battery scheme since its launch following the election in May. And so what we're showing on the chart here is our projections for both coordinated and uncoordinated CER storage in our forecast. And so we're now projecting this to hit 6 gigawatts in 2030 when the scheme is subject to end. The kind of growth will start to decline after that, we think, but yeah, continue long term. The big thing here is probably that split between coordinated and uncoordinated. So uncoordinated, so batteries which are behind the meter, sitting at household level, doing, say, solar shifting, but not trading directly in the NEM. In coordinated, we're showing projects which are grouped under VPPs and actively trading. So we still think these are going to be the minority of distributed battery energy storage projects going forward. Awesome. And Marcus, I'll hand to you now to run us through latest market updates.
Thanks, Wendell. So I want to start by recapping the current state of BESS in the NEM. So we currently have 3.6 gigawatts of operational capacity at the moment. This is a 45% increase from the beginning of the year, indicative that there is a rapid deployment of batteries, but also because batteries are getting larger, which is really bumping that number up. If we look at the green stack here, we've got projects which we've categorized as advanced. So this is all the way from FID to commissioning. And these represent 9.7 gigawatts of the battery capacity pipeline. And we think they're very likely to come online by the end of 2028. So within this, we have 3.1 gigawatts in commissioning at the moment, with 2 of that expected online by year end. So by 2028, it seems very probable that we will quadruple our operational BESS capacity. If we then look at the orange bar here, we've got the rest of the pipeline, which is batteries in various stages of pre-planning, which could, again, double the amount of live and advanced projects by 2028. So Wendell, how much of this do you think is likely to come online?
Yeah, I mean, so you can see in the purple bar our projection for what we think will be online in grid-scale battery energy storage capacity by the end of 2028. And so when we take so 3.6 gigawatts we've got live, and the additional 9.7 gigawatts that have progressed past FID, that takes us up to 14 to 14.5 gigawatts. And so, we think it's very likely that we'll see another 3 gigawatts out of this planning category come online by the end of 2028 as well. So that's projects which are in that darker orange planning advanced section. So these, projects that we see having tangible progress. Also, some of those which have got, say, our Tesla scheme contract. And that will take us to 2028 and that 17 gigawatts.
Yeah, and it's not to say that the rest of the projects won't come to market, but it's just likely that they will be delayed or take longer to reach market. So now looking at the revenues over the last 5 years, I've broken these down into separate markets. So we've got the purple representing energy revenues, and then we've got the 2 shades of orange, which represent FCAS. So the immediately obvious trend here is that FCAS revenue has been shrinking over the last 5 years because of FCAS saturation. So this is caused by the entry of new batteries into the market, and they're outbidding each other in very shallow markets. We're also seeing that batteries are becoming larger on average, meaning that that same FCAS revenue is actually making up a smaller proportion of their total revenue, which is also shrinking the stack. The other thing to note here is that energy revenues have also been increasing over time to offset this impact, which is indicating that operators are sort of changing their strategies to now focus on energy rather than FCAS.
Yeah, and that's something we're actually seeing, with some of the most recent projects of, say, 200 megawatts to come online, especially in New South Wales and Victoria. They haven't actually participated in any FCAS yet. They're just pursuing a wholly energy trading strategy, which really reflects where they see the value being long term.
Yeah, and if we now break it up by market over the last 12 months, we can see that those same FCAS revenues mainly affect Queensland and South Australia. But not only that, but they're very concentrated to a few months of the year. But they are quite high value. So we've seen these affect those 2 states because they're located on the edge of the NEM. And sometimes transmission constraints bind, and AEMO has to procure FCAS locally, which can lead to extreme pricing in these cases.
Yeah, and that event back in July and August and September, in South Australia, we've covered that actually quite a lot in our research. And it's really interesting. It's really shallow in terms of the market depth at that time. So it's just 100 megawatts of extra F-gas, which is being procured locally. But actually, what triggered the prices we saw was the island basically excluded some batteries. Some aren't registered for 1 second. And so you were left with just a few systems to provide that extra F-gas.
Yeah. And what we've got here is our capture rate analysis for different batteries across the NEM. So our capture rate is the revenue earned by batteries. And then we also factor in the potential revenue after we've adjusted for marginal loss factors, transmission constraints, which prevent batteries from capturing high prices, as well as availability and a number of other smaller things like contracts. So what we can see is that there's a large variance across the states and within the states as well. So this is driven by state dynamics as well as different auto bidding software as well. So Queensland batteries have the highest and the most consistent capture rates, where the top and the bottom performing assets only differ by 8 percentage points. So it's really quite small. Whereas if you look at South Australia, you can see these batteries performed the worst out of the state. But surprisingly, they actually outperformed in terms of revenue. So why is that?
Yeah, so ultimately what we're looking at here is the proportion of revenue that was captured against like a market benchmark that it's based on market prices. And in that South Australian instance, so much of that value is weighted towards what we saw in F-gas. And so, it was such a shallow increase in demand that triggered those price spikes that these batteries couldn't actually bid all of their capacity that was available into those markets without crashing the price. And so to maximize their own returns, they essentially derated the capacity they were bidding, which ultimately harms their capture rate that we're showing here, but maximize their returns.
Okay, I'm going to hand to Wendell now to discuss 5 things we should think about when investing in BESS.
Yeah, so before we really jump into the business case, I wanted to just highlight 5 things here that I think are really important for anyone who's building, owning, investing in battery energy storage and them to be thinking about going forwards. So first one, we kind of touched on this later with our forecast, but you should really be thinking about caps when you're assessing your project value. And so what we've just been showing is reflective of the value batteries would be earning in the 5-minute spot market. However, when we talk to the companies that are actually trading these batteries, it's clear how much they put in, clear how much weighting they put on the value that they can actually trade those batteries against in the caps market. This also reflects what we've seen coming out of Gentators recently with likes of AGL highlighting this also. Marcus, you did this bit of analysis on caps. So can you just maybe introduce what caps are and then what we're showing on this chart?
Yeah, for sure. So a cap contract is a financial derivative that protects the buyer of it from wholesale prices when they exceed $300 per megawatt hour. So what happens is the seller will return the difference between the strike price and $300 back to the buyer. So it's essentially an insurance thing where it caps their exposure at $300. So what we're seeing is that a lot of batteries are actually selling this type of contract, which makes a lot of people question, well, batteries earn most of their revenue from these really volatile periods. So why would they forego that upside? And it's really because the buyer of the contract will pay a large upfront premium based on the contract price at the time. And in a lot of cases, this can exceed the liability that the battery is responsible for. So it makes sense for them to sell it. Another thing we're seeing is that batteries are quickly becoming the ideal technology to defend these cap contracts because they can ramp up within a 5-minute interval and really capture these high price spikes, whereas other generators which sold caps like Snowy Hydro and certain gas generators, they can't ramp that quick because of their restrictions. So looking at this chart, what we've got is the merchant revenues for Ballarat over the last 3 years, split by quarter. And you can see there's quite a large range where in some quarters it's earning almost $0 and in other quarters it's earning up to $60,000 per megawatt. So on the right, we have the counterfactual scenario where if it sold 20% of its capacity into contracts, we can see that the spread in revenues is actually reduced, making the revenue certainty making revenue a lot more certain for the developer. And what we can also see is that the average value of this quarterly revenue is increased compared to a merchant because of that premium for providing the insurance.
And so a really important thing to think about actually with caps is you can't just go and sell, well, you could, but it might not be the best strategy to go and sell 100% of what your battery power as caps. In this instance, we've calculated that Ballarat could have sold maybe 20% of its battery, its power capacity across this range. And that's because it's a short duration battery, and that also reflective of the kind of pricing dynamics that we see in Victoria. But when you think about this long term, this changes with longer duration batteries. So, for example, a 2-hour battery today might sell 90% of its capacity power against caps, and 4 hours really, you can quite confidently sell a lot of that power capacity. But going forwards, this will change. Price spikes are going to change in the NEM. Things like Dunkelflauters will actually mean we get longer price spikes, and so over time, your 2-hour battery, you would want to sell less of that against caps. This is something we think about in our forecasting, where we look at the changing shape in price volatility and how much we think would make sense to sell of your battery capacity. And so a key thing really actually with that is at the moment that caps market, there's barriers to entering that. At the moment, I'd say only sort of the biggest off-takers, traders in the market are going to be accessing that market. But this is something that the Nelson Review is trying to tackle, increasing the visibility and just access to that market. And it's doing this actually to help drive this long-term investment signal through the ESEM. And so the Nelson Review, the first recommendations of that were released in August. And the headline was that ESEM, so a new long-term mechanism for incentivizing new generation and flexible tech capacity to come forward in the NEM. It would replace the capacity investment scheme. And so it does this through, we've kind of got an example on screen now, but so it provides a long-term contract for years, say 5 to 7 onwards of a project's lifespan. And in the front end, the owner or developer is still expected to go to market and maybe get a contract from an off-taker, or if they wanted to just leave it merchant, with that long-term element reflecting what would be needed to make that project kind of reach an investment case. And so this would be determined by a competitive auction. And so, the cheapest technologies, or the ones who can kind of really make the business case work, be the ones to actually get that contract. In this example, we're showing one where maybe the battery is able to get a pretty decent toll value for the first 5 to 7 years, which then means actually longer term, and they're able to take a lower contract. But with that secure guarantee of that, they're pretty happy to take that away. In this example, those are flipped. So in the shorter term, there's much lower expectation of what the battery will be able to earn in the market, which means it would need a much higher contract value in the ESEM in the long term.
Yeah, so Wendell, you mentioned the capacity investment scheme. I guess these two contracting structures offer long-term support for batteries, but how do they differ, or what are the advantages of the ESEM?
So I think there's 2 main advantages of the ESEM. So the first is, the capacity investment scheme is sort of like an underwriting scheme. It's downside protection. And so if a project actually hits that downside, they're not incentivized to actually participate efficiently in the market. Whereas because the ESEM is going to be driven through derivative contracts, which will have that link to the spot market, in theory, you should avoid that sort of downside. Secondly, and this is something that I think is really important to myself, it looks like the ESEM is supposed to be much more transparent. So both in terms of the types of contracts which are being won, and also the price of these contracts, which should give a lot clearer indication of what the value of these technologies is long term. This is something that's really missing from the capacity investment scheme at the moment. So number 3, sort of in the absence of maybe going and getting that support contract, off-take contracts remain crucial for building a bankable battery energy storage project in the NEM. And so what we're showing on this chart is a bit of a chart from one of the recent research pieces that we did on this. And it's showing the cumulative capacity, battery energy storage capacity by commissioning year, which has an off-take contract of some sort, so split between physical tolls in the blue and the new sort of virtual derivative-based contracts in purple, as a portion of the whole capacity that's being built. And so when you look at that, it's around 40-50%. But actually, if we take what's left, we can see it's not quite a clear comparison. So there's a chunk of this capacity which already has a sort of a significant government contract. So for example, Waratah with its SIPS contract. There's actually many other projects which have just got direct government funding. So for example, through the SEC in Victoria, there's a big chunk which belongs to gentators who have a different business case in terms of how they're going to be investing in these assets. So actually that just leaves the little chunk we've got in the light gray in other. And so if we were to get rid of these sort of other categories, actually 80% of capacity, battery energy storage capacity that's coming through and being financed has an offtake contract. And so, yeah, for any project actually looking to get financing, it's clear that banks are still really leaning on an offtake contract for project bankability. And something that might actually help that is the sort of grid forming. And so some research that Marcus did actually recently showed that for new entrants to the market, grid forming is quickly becoming the norm for battery energy storage. And so, yeah, you did this research, Marcus. So do you want to talk us through actually what is grid forming and why are we seeing this shift?
Yeah, thanks, Wendell. So grid forming refers to a battery's ability to create, the battery's inverter's ability to create, maintain its own voltage source as well as frequency rather than following the grids. So this gives it the ability to provide inertia, voltage support. It can assist in system strength markets as well, and even help with system restart. So there's a few reasons as to why batteries are choosing to become grid forming. And I think the first is it comes down to cost. So the cost of grid forming is now on par with grid following, meaning that there's not much reason to not choose it. In many cases, the cost to upgrade to a grid forming system is very small as well, considering they have the same hardware. It's just a software difference. So what grid forming does is it actually allows batteries to self-remediate their system strength impact and avoid paying system strength charges. So we've seen that system strength charges can cost up to 10% of a battery's yearly revenues. So this is quite significant when it comes to the battery business case. There's a lot of options long-term or possibility long-term for batteries to provide these system strength services as well. So Transgrid recently put out a tender for 1 gigawatt of grid forming batteries by 2026, which offers batteries an additional revenue stream on top of their merchant energy and FCAS revenues. Yeah. So this is really being managed by the TNSPs as they assist with the exit of synchronous generation and maintain that security of the system.
Yeah, I was just going to say, I think if I had to pick one thing that was probably something to keep an eye on at the moment happening, it would be that Transgrid tender, because it's going to be the clearest indicator that we've had so far of the value of sort of some of these network support contracts for batteries. And, you know, when we look at, so New South Wales, but also Victoria, South Australia, Queensland, it's not insignificant the amount of grid forming batteries that these TNSPs are looking to contract. And so, you know, it could become something really important long term, but at the moment we're still seeing that market develop.
Mm-hmm. Another thing here is that some studies have come out from ARENA showing that providing grid forming services like system strength don't cannibalize your other market revenues. So the upside is really huge while there's almost no downside for picking grid forming.
Awesome. So last thing I just wanted to highlight is really to think about the locational impacts and of where you are on the grid and how this might impact the revenues that you can earn. And so what we're showing on this chart is, so for 3 different locations that we've picked out in New South Wales, the reduction in annual revenues over a 10-year horizon that they would earn compared to a system in Sydney. And so, this reduction is split between impacts from margin loss factors and constraints. And so margin loss factors, it's like relatively simple. So essentially, it's a factor that reduces the value of any energy that you export or for an export MLF. And so that just directly reduces the revenues that you get for trading. A thing that we also see happening long term is when you've got a much bigger fleet of battery energy storage, it also changes the competitiveness of certain projects in that stack. So if you've got a really poor export MLF, you know, you can't compete with some of these batteries with, say, an MLF of 1. Then on the constraint side, so this is something we really see impacting at the moment, are batteries which are in southern and southwest New South Wales. This is something actually we've seen happen over the last couple of years, and we continue to see it forecast. And so essentially these projects, there's transmission constraints which can prevent generation from these batteries and also other renewable generation in this region reaching the regional reference node in Sydney. What this does is it obviously prevents those systems from discharging into periods that they want to. And it's also a bit of a sort of double-edged sword because those same constraints can trigger price spikes that projects in the rest of New South Wales can actually access.
Yeah. So locational constraints and MLFs are only one part of the picture as well. Like there's a lot of other reasons why batteries would choose to build in remote or constrained areas of the grid. They could access grid forming contracts like I was just talking about before. I think a good example of this is Williamsdale in the ACT is actually being contracted by the ACT government. So there's other revenue streams that may also help assist with this decision.
Yeah, that's a good point, Marcus. Like this shouldn't completely like dissuade you from locating a battery in certain areas of the grid. But I think for me, it's just like the key thing I would say is just, get an eye on this early, have an idea of what these potential impacts on your revenue earning ability could be before you really spend loads of time developing a project. Awesome. Now, Marcus, do you want to take us through the final section looking at our forecast?
Yeah, let's do it. Okay, what we have here is merchant revenues over the next 7 years split by region for a 100 megawatt 2-hour battery under our central scenario. And the first thing that is obvious to me is that it's almost entirely purple being made up of energy revenues. So we were discussing before these FCAS contingency spikes in South Australia and Queensland, and they provide little value long term just because of the shallow markets and the fast entry of battery capacities. We're also seeing near-term revenues fall quite slightly as new battery capacity comes online and these new regions become interconnected with each other. Following that, we see the retirement of coal-fired power stations, which creates more volatility, which batteries can then capitalize off. This is most significant in New South Wales. But following that, in 2031, we also see Snowy 2.0 come online and then really squash those revenues and spreads again.
Awesome.
And what we're seeing on this slide here is the 2 versus 4 hour CapEx in 2023. And now if we just jump to 2025, we can actually see the cost between these has actually shrunk as 4 hour batteries have become more cost competitive. This is mainly driven by improvements in the technology as well as falling lithium prices. So most of this reduction comes from the purple section here for containerized BESS. There's also several market drivers that are making 4 hour batteries become more attractive as well, as our forecast suggests. And in recent months, we've also seen lots of instances where price spikes have lasted more than 4 hours and the battery fleet has run out of charge.
Yeah, this is something we actually touched on in the last live stream. So when we look long term, so 2027 onwards, and actually reflective of all the projects we're really seeing come to us now, the vast majority of these are 4 hours in duration, as opposed to 2 hours, which has been the norm for projects coming online in the next 1 to 2 years. And so, yeah, CapEx, one massive driver of this, but the other is that changing price shape long term.
Yeah. And now if we look at our 4 hour spreads over the forecast, we've got our historical on the left and then our forecast on the right, but it's chunked into 5 years. And what we can see here is that they sort of follow that same trend I was discussing before, where they raise with coal retirements and then they slowly trend down towards the end of the forecast as batteries become cheaper and they're able to meet their IRRs off a lower spread.
Yeah, and I think really important to think about is we sort of highlighted how much battery capacity is coming online. So if we think, start of this year, we had 2 gigawatts of grid-scale storage online. At the end of this year, we expect that to be 5, maybe 5.5 gigawatts. And at the end of next year, probably 9, 10 gigawatts. So very quickly, we're seeing a significant amount of new battery capacity. And actually very little else is happening on the grid in that 2-year period. And so for the next 2 years, we really would expect to see volatility that we have seen in the last 3 years start to decline. But then, when we hit 2027, 2028, we start to see those coal retirements, and then that kind of changes the picture.
Now, if we look here, we see different ways that a battery can structure its revenues, whether it go and sign an offtake or if it go and sell caps or some combination of the both. So do you want to talk us through how a battery can think about this?
Yeah, so kind of what we're showing here, so from left to right, different ways that you might structure a business case for a battery. So starting on the left-hand side, so pure merchant only, you're accessing spot market revenues. This isn't really actually reflective probably of many projects that are getting built today. And then, so what we see to the left of that, to the right of it, is if you have, let's say, a 50% virtual toll. So so 50% of it you've locked away in a long-term contract, maybe 15 years, with the remainder merchant. And so in this instance, actually, that's having so essentially no impact on the long-term value of your project. But what it is doing is it's providing 15 years of sort of very certain revenues, which means all of a sudden your project can be banked and reach financing. And so that kind of reflects ultimately why we're seeing just still such a significant uptake of those offtake contracts in the projects that are reaching FID. Now, if you go to the other half, so now we're showing maybe what a big gentailer would be seeing when they're valuing a project. So they've got that merchant component and also what they can earn by selling caps with the battery. So this gives quite a significant uplift over the time horizon of the project. This might not actually be completely accessible for all in the market, but for the big trading companies, big utilities, this might be what they're seeing. And then finally, at the end, we've got maybe what you could put together if you were particularly trying to stack everything together. So you have some trading capability in-house, so you're trading your battery in the spot market, but also selling a portion of that as caps. You've got a partial toll, maybe for 50% of the battery, that's locking in the value, which is still really crucial for bankability. And you've also got a network support contract in there, just providing a bit of a top up. But ultimately, yeah, this is kind of upside as you talked about earlier, Marcus. And so what we're showing on this chart is then what that means for the rate return for a 4-hour battery that's being built in the NEM. And so in each of these bars, we've got kind of the range in IRRs from these different structures. So on the left-hand side, so in our central scenario, if you've got a merchant-only project, you can, in the best regions, you can hit that 10% hurdle. However, if you're saying Victoria, actually, you're struggling at the moment. Now, as soon as you layer in an offtake in there and think about what that offtaker could be valuing the project for, you see that start to nudge up. And then when we look at the last two categories, you really see how these shift the investment case for storage. So for our sort of gentailer example, it really makes it look quite positive, as well as those who are able to really stack and maximize the value of their battery across these different services.
Cool. That takes us to the end of our presentation. I just want to remind you to check out the Energy Academy Australia edition, where it's a 10-part free video series where we discuss how electricity is produced, how it's consumed, how the price is formed, who the key market players are, as well as a lot of very Oz-specific things in case you're not too familiar with the market. That takes us to our Q&A section now.
Awesome. So yeah, we're just going to put some questions up that we've had through. Do please keep submitting them. So first up, we've got one which is so around the price we're assuming for offtake agreements. And so we recently actually put together a research piece looking at this. We've kind of got some pointers from the market, but it isn't really transparent. The way we really look at it is to take, say, projected revenues. You'd have a slightly more conservative view of that, but then you are layering in that value which you think you could get from trading that as caps. And so that's kind of the way we look at it. We've got a research piece which dives into this in more detail. So just picking up a different question. So thanks to Phil for this. So I think we kind of just touched on that there. So what does the ultimate BESS project look like at present, given location, scale, infrastructure, and expected long-term returns? So the best regions we'd see right now are either if you're locating in sort of central New South Wales or in southern Queensland. This does actually reflect then where we're seeing the bulk of battery growth long-term. And then in terms of kind of configuration, it would be a 4-hour battery. We have seen that really shift in favor of 4 hours over 2 hours now. And the scale side, ultimately, I guess that we can only really take indications from what we're seeing in the market. And so 200 to 300 megawatts seems standard, but then we are seeing that shift towards 400. I think the key thing to think about there is actually the size of the offtake agreement you can get. When we look at the market, really at the moment, this caps out around 200 to 250 megawatts. But yeah, I think that's the main thing for me. I don't know if there's anything you had here, Marcus.
Yeah, nothing to add.
Awesome. Yeah, I think this is a really good question. Maybe Marcus, and this is one for you. So how do we view the potential revenue from providing system strength services? How do we think this might cannibalize long term, like we've seen for ancillary services? Like ultimately, how deep is this market?
Yeah, because the system strength market is so highly locational specific, it depends on the requirements of the nearby transmission infrastructure. There is going to be some degree of cannibalization just because of the amount of batteries, but the amount will be quite small. So in our research piece, we've looked to other markets as well and sort of benchmarked what the contract value could be based on similar technologies in similar markets. Yeah.
Awesome. Yeah, and I mean, I think the key thing is the locationality of those contracts. Like some of these services, like reactive power, are highly locational, and so you're not just competing with batteries across the entire state like you might be for FCAS. You're just competing with the batteries around your local area.
Yeah. Just to add a little bit more context to that, so we're seeing batteries become the ideal technology for that as well, because they can layer on these their traditional earnings as well, making them the most cost competitive compared to a synchronous generator, which only has one function, and that's to provide these system strength services.
Awesome. So we've got a couple of similar questions coming up now. So first up, so what revenue opportunities might a 10-hour battery provide? I might just think more about a long duration, maybe 8 hours plus. And so the things really is, it really does start to shift actually battery sort of like operations day to day, going from 4 to 8 hours plus. In general, the price spikes we're seeing, like price events in the evening, tend to be 4 hours or so before you're starting to lose value there. But where we do see a value long term, like I mentioned, is actually in those cap contracts. And so because of the changing nature of price shape and volatility long term, where you might be pretty comfortable selling a lot of your batteries, 4-hour batteries caps today, in 5-10 years, you're suddenly feeling a lot less confident, and you want an 8-hour or 10-hour battery, 12-hour battery to provide that same service. So ultimately, this is something that we're seeing kind of change. I mean, what probably about to get onto it, it's clear that the longer duration projects that we're seeing come through at the moment still need specific government support and it will get built. But things like caps do start to swing in their favor.
Mm-hmm. Yeah, there's just like a lower market signal for longer duration batteries, but there are definitely ways that they can earn money, like through either contracting or government support.
Awesome. So a slightly similar question, around longer durations, BESS. So given the amount of longer duration BESS that government offtake is bringing into the system, and that is intended to precede coal retirements, wouldn't you expect a much deeper energy market value erosion? And so I think the key thing here to think about is we do really see like erosion of spreads from like kind of the more volatile events that we've seen, let's say this year. So if we take the example of June, which was one of the highest value months for batteries, kind of going back over the last few years, with the amount of battery capacity coming online next couple of years, we see that that kind of event would have significantly less value for the fleet going forwards. However, when we look at fundamentally like the base level of spreads which batteries can access on a day-to-day basis, the floor to this is actually quite solid. So if you think about it, pretty fundamentally, you've got loads of solar generation in the middle of the day, and then you've got that declining in the evening with generation having to ramp up, so coal and gas. And fundamentally, that has a spread which persists even with the amount of battery capacity we're seeing come online. So I'd say, that's my answer to that, is you're kind of seeing the really volatile periods start to reduce. And actually, I mean, if we think about much longer term change in terms of the dynamics, but that fundamental price shifting between sort of daytime to evening peak actually gives you a pretty solid floor to your revenues. Awesome. So next one's around co-location. So do you see higher prices for solar and BESS hybrid offtake contracts versus standalone BESS contracts? I mean, I think fundamentally we would do. The way we actually see most of these happening in the market at the moment is through probably slightly different. So You have firm PPAs. There's a few of these which have been announced in the market, which basically provide a contract for the combination of solar and BESS output with a firmed profile. So you're having more of that evening peak demand covered. And yeah, we really would expect that to have a higher value. This is a bit of research we're going to be doing soon. In terms of how that compares to, say, a virtual toll, yeah, I think over the whole project, that's something we'd have to take away and assess. But yeah, that's definitely something we'll be looking at in our research. Sorry, just having a look through questions. So next one. So do we have a price? Thanks, Tim, for this. Do you have a price on what the round trip cost of a BESS is? If we're looking at the model, it's purely transactional. So ultimately, yeah, if we look at the kind of what the round trip cost of a battery energy storage system is, there, in terms of actual cost, there's two things, I guess, here, which is the efficiency cost. So yeah, the round trip efficiency that you're using might be like 15%. And then there's like a degradation cost. So, you know, that cycle does physically degrade your battery, which has a cost, although that's relatively small in the scheme of things. What's interesting is, you know, efficiency, if you think about it, predominantly comes through needing to charge more energy. But if your energy that you're charging with is zero priced or even negative, you know, the impact of that efficiency on your kind of cycle value starts to really sort of degrade. Yeah, I think that's kind of it for me. On the degradation point, as I mentioned, this, you know, there is a physical cost there, but long term, it's pretty insignificant. Much more impactful, actually, in most of it is going to be the opportunity cost. So what else could you do with that cycle or that energy in that day? And so that ultimately is what determines a lot of, you know, say the minimum spreads batteries would trade at versus actually these maybe physical components. So a question on FPP. Have you looked into FPP as a revenue source, and what do you see happening to this value moving forwards? Marcus, this was a piece actually you looked into recently, so yeah, please let us know.
Yeah, we did look into the value of the FPP, and we found that it was quite insignificant compared to normal regulation revenues. So the long-term number, I believe, was around, the number that we calculated was around $750 per megawatt per year. So obviously quite small compared to other merchant and even regulation revenues. And this is mainly because it is tied to the regulation price. And what we've seen is that with all these batteries coming in and bidding very low in regulation, it sort of degrades the value of that.
Awesome. So
one interesting comment that we had from a reader was saying that they might actually reduce their regulation bid by the amount that they would earn by FPP to make it even more competitive.
Awesome. So next question, I think, yeah, this is a really good question. And so something actually we're going to be covering later in the week. So we've got our sort of investment outlook coming out, which will really look at this topic. So do you see IRRs for a 4-hour battery being superior just based on relative capex reduction, or does it assume spread opportunity lasts longer and or capture rates are higher? Yeah, this is a great question. So like we touched on, so yeah, we think, well, we see and we project 4-hour capex to keep falling relative to 2 hours, but that alone doesn't necessarily account for the shift that we have seen. So yeah, at the moment we do see project returns for 4-hour battery being better than a 2-hour, and the big thing there is a changing price shape long term. So the amount of 2-hour battery capacity that's coming online in the next couple of years really means that the volatility that was sort of an incentive for that to come online is going to start being squished, move towards 4 hours. And so, so all of a sudden you're seeing a different price shape. So like you said, so spread opportunities last longer. There is separately, an element around these 4-hour systems actually are better able to capture some of the price spikes we see happening longer term. Awesome. We might wrap up there. But yeah, thanks for all of your questions. If there's any questions we haven't answered yet, we'll make sure to answer this after session, and we'll be sending that out. This was recorded, and yeah, we'll be sharing it all before the end of the week.
Yep. Thank you for joining.